Making $1 million in net, say over like a 10-year period or whatever, it's really fun until you see the tax bill, and then you're like, holy cow.
Michael is an investor and developer in Houston, Texas. He has transacted over 250 million in multifamily deals, and has helped investors place 57 million in equity capital. So Michael has invested in about 5,000 or 5,600 units across 30 different properties. So wow, welcome! It's great to have you on.
Thank you very much.
I
Great to
imagine a
be
large part of that that number, or not a large part, but that number is probably really bumped up by the property that's right behind you in that background, huh?
It is. That accounts for a good portion of it. But yeah, that's the number for all of my GP deals. But I'm also very active on the passive investing side. So I've done. I think that number is a little bit old. I had 10 properties as a GP, but 22 properties as an LP, and I still to this day continue to invest actively on both.
So, what are some of the whether it's personal or just when you're working with investors, what are some of the benefits that you see that you're looking for, what they're looking for in investing passively in multifamily?
Well, yeah, I mean, it's. I think first and foremost is that thought process there is the passive side of it, right? Which is someone else is kind of putting in most of the effort in terms of finding the deals and then running the deals, and you hear the term mailbox money all the time, and that's exactly it, right? So, and whether it's because it's just fun. You don't have the skill set or the ability or the time to invest in that asset class, right? So it could be because you've got a W-2 job, and so someone else is doing all the work. Or in my case, where I've invested in like an industrial product and stuff like that, and that's not my wheelhouse, but it is a product that I do believe in, and so I want to participate in it, but I don't have any other way to do it. So I have to invest with somebody else that I feel that can, obviously take care of my money and do a good job in an asset class that I believe in.
How important is the tax benefits for? I mean, here preface it with this. In my opinion, tax benefits should not be the leading reason to invest in anything, but for a good investment like multifamily, it can be a substantial secondary benefit. So, how important do you see that having on your accelerated returns?
Like you said, it shouldn't be the leading reason for it, but it's a big part of it, and it becomes a bigger part the longer you start investing. Right, when you're first starting to invest, it's kind of one of a secondary thing. But as those gains start rolling up and deals start going full cycle, and you have these gains that you've invested from 3, 4, 5, 7 years prior, and then they start growing in size, and that's kind of what you want, right? You invest that $100,000, and
Yeah.
5 years later it becomes $200,000. So that's $100,000 in gains, and then you got to find a place to put that. Hopefully, that you kind of deferred the taxes on that, and then you invest that, and then 5 years later, now it's $400,000, and now you have $300,000 gain on top of your original $100,000. So over time, it becomes much more important, which is what you want. But then now you have to figure out what to do with it. First world problems, right? So
Yeah, making $1 million in net, say over like a 10-year period or whatever, it's really fun until you see the tax bill, and then you're like, holy cow.
exactly.
What are some of those benefits that passive investors see on the equity side, or investing in equity in multifamily from a tax standpoint?
Obviously, is a big part of it is kind of the deferring of the tax payments, right? And that can be done multiple ways. If you invest as a passive investor, and you're going to get, in most cases, depending on what type of deal that you're investing in. But if you're investing in, let's say, an apartment building, you'll get some tax depreciation from the property, and so that'll be a negative, I guess, number on your income tax that'll offset any of the positive numbers from your distributions that come in, and that can be deferred for quite a bit of times depending on the goal of that property. Some people have refinanced their property 3-4 times in the last 10 years, and so you're getting a lot of the benefit of the growth of the property, the appreciation and the cash flow in the property, and yet you still haven't paid any taxes in a while, or limited taxes in a while. So eventually that gets recaptured back, and then you'll have to come up with, like we said, different strategies of how to defer that even further, kick the can down the road a bit, whether that's investing in a new property or some of the newer, opportunity zone properties. But regardless, even if eventually you do end up paying taxes, there's still benefit because you're paying that taxes, many years later, and time value money, especially now with the inflation that we have going on.
Yep.
We know that this money, in the future, it's not worth as much because of the inflation, right? So
100%, yeah, because that savings, say it was 100,000, so you got a windfall, and
Yeah.
then you get $100,000 tax savings that you've accumulated over a 5-year period. That 100,000, it should be, if you're a smart investor, that should be making money. So it's almost like the tax money, the government lets you borrow it and make money on it. So when you pay the 100,000 back, like, you actually made money on that, but because you bought a new property and it has tax benefits, like,
That's right.
that's where the strategy and a good CPA becomes a
Yeah.
vital asset.
Exactly.
We got like 2 minutes left. As someone who works on the GP side, so general partner, meaning sponsor, operator to some degree of a property, when so both sides. What are questions folks should ask a sponsor before getting into a passive investment in multifamily?
I think it has to be a fit in the sense that it has to be the right type of product. If someone comes to me with an asset class that, if as a passive investor, I get propositioned all the time, and it has to be an asset class that I believe in a market that I believe in. But more importantly, I look at the sponsor, and I want to understand what their goals are and how do they work, how do they communicate, how often do they communicate, are they local or close to the property, or they visit the property often, or that area often, and how familiar they are with that, and what sort of team do they have behind them. So it's kind of all of the above, but yeah, it can be overwhelming when you're first getting started out. And I think that's kind of why I tell all the passive investors that they really kind of have to just kind of take their time. There's no rush. There's always a fear of missing out. You seeing all the numbers getting thrown out there, and people, and a lot of times maybe you hear it from a referral that someone says they did such and such, and they did so well, and you kind of want to jump in, but just take your time, get educated, and then get to know the sponsors before you jump in.
100%, and that echoes a previous show we did. And the theme for most of the guests was the jockey over the horse. So a good sponsor can take a good deal and make it great. A bad sponsor can take a good deal and lose all your money. So definitely vet the sponsor.
Definitely, and I've seen that across all my deals, right? So
love it. Any final thoughts?
No, I mean, just for anyone right now thinking about jumping in, it's still a good time, but just be careful and get educated and get to know the sponsors and the deals and the asset classes.